Welcome to the Silverbridge CPA's Summer Speaker Series. We hope you enjoy this message.
Welcome everybody, and thank you for joining us for our last Summer Speaker Series of 2023. My name is Brittany Williams, and I'm Silverbridge CPA's firm administrator. We are very fortunate to have Stephen Schultz, partner and financial advisor with, someone's waiting. Okay, with Family Tree Financial here with us today. Stephen will dive into several investing strategies that you can take advantage of, along with where you should put your money in our current economic situation to create more income, growth, and stability. I'll introduce him shortly, but just a few items to go over first. If you haven't already, please be sure to mute yourself. You can do so by clicking the little microphone in the upper right-hand corner there. The presentation is also being recorded, so if you do not want your face to be on screen, you can go ahead and click the camera in the upper right-hand corner, and that'll take you off. And then throughout the presentation, you're welcome to type your questions into the chat feature, and we will save some time at the end to go through those. And then if we've, still have extra time, we can go ahead and just unmute ourselves and ask questions that way as well. With that said, I will introduce our speaker. Stephen was inspired to help others with their financial goals from an early age. He saw how hard his parents worked to provide for their 7 children, yet struggled to find financial peace. He took that desire to help families to his studies at the Ohio State University, where he earned a degree in human ecology with a specialization in family financial planning and behavioral science. Stephen has been in the financial services industry for over 15 years, 10 of them as a financial wholesaler in Southern California, consulting hundreds of financial advisors about retirement challenges and solutions. In 2016, wanting to have a direct impact on individual families' financial success, Stephen transitioned to a financial advisor himself. He started his practice serving teachers, to whom he has a special place in his heart, coming from a family of teachers. He continues to have a passion for serving those that serve others. In 2018, he moved with his family to Idaho to start his own holistic financial services practice. Stephen helps his clients preserve and grow what is important to them while educating clients on how to create their own financial roadmaps. All right, Stephen, I will go ahead and turn it over to you.
Thank you very much, Brittany, and good morning, everybody. As Brittany mentioned, this may have just been something that people think summer's over. Well, like my wife, I will tell you, we have at least one more good hard week of summer left, and hopefully we'll get to enjoy some hot temperatures for one more weekend before fall is upon us. I, for one, am looking forward to fall. As Brittany mentioned, she let me know about this summer series a long time ago. It was probably December of last year, and to pick a topic that is going to be in the future relevant for 10 more months or potentially longer is a tough bill, but that's why I chose to talk about inflation and the Fed's fight against inflation with their raising of interest rates. Still very, very relevant today. And I would add that maybe this topic is kind of right on the cusp of potentially a dynamic shift. And so what we want to do today is just go over some of those indications of how we got here. We want to see where maybe some opportunities for our assets currently, and then certainly talk about where that shift will lead us to as inflation gets tamed and interest rates hopefully come back down in the near or at least shorter term here. So I'll jump into our discussions today. As Brittany mentioned, feel free to put any questions you have in the chat, and we'll save some time at the end for further discussion and to open the doors for those. There we go. All right, so a little disclaimer just to say that I have an opinion. My opinion is sometimes the same opinion of my broker-dealer, Osaic Wealth, but today is my opinions mostly and mainly. So let's start off with looking about where inflation has been. The chart that you're looking at right now shows the last 50 years of inflation in the United States economy. We can obviously see the hardships that we went through in the 70s and the decade of the 80s that followed, but obviously more relevant today is this area that we're looking at the tail end of our chart here. So my beautiful green highlighter will guide us through today's discussion. And as we can see that some of these numbers up in the chart above point to headline CPI. There's different levels of inflation, different indexes or different statisticians that actually produce different inflationary numbers. But we've actually been seeing, obviously, that hardship of what happened in 2020 and how we got here. So let's go back to 2020. Obviously, we're talking about the COVID pandemic that interrupted our nation and in the globe. And so when inflation is present, it means one thing or a couple things are happening in tandem. But the definition of inflation means that there's too much money chasing too few goods or services. And so that was obviously relevant in 2020 as the pandemic caused shutdowns and it caused just different interruptions of supply chains and the like. So the government at that point, led by the Federal Reserve, right? We had both the Federal Reserve and the administration make different changes. The Federal Reserve had a couple different impacts when it came to inflation. One, that they did obviously raised or lowered interest rates to all-time lows. They raised or lowered interest rates to 0% levels for a good long time. And now we have the effects of what that means. So when we introduced stimulus and the fact that that was like $6 trillion, not to mention people had lower supply to actually go after because supply chains were broken. That led to a lot of money chasing around goods and services. So we ended up building into our savings balances and wanting to do what the American consumer does and spend, 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 baby. But we did that a little bit too hot and too heavy as we led into the 2021 year, as we kind of got a little bit more familiar with the pandemic and kind of a little tired of sitting on our butts. We wanted to go out there and kind of have some good times in the summer of 2021. And throughout last year, we did that. So inflation was there certainly, and we can see it spiked almost to an all-time high, at least for this round of inflation, back in the summer of 2022. That headline inflation number that you saw from May here on this chart at 4.1 is actually calmed down, but it was as high as 9.1% back in the summer of 2022. And even though inflation, you can see this trend line here is what they're trying to dot with this dot line. Inflation historically, at least for the 30 or 40 or even 50-year average, has been around 3.25%. And you can see from the last 20 to 30 years that inflation has been well under that, with some peaks in between for that headline number. But again, that's been really the fight of the Federal Reserve for the last 20 plus years, as inflation has been below the number that they feel like they want. Inflation is a good thing for the U.S. economy. That means increasing growth. That means increasing wages. That means that we have more money to go out there and buy the goods and services that we want. So a healthy amount of inflation is good. But whenever we see things are getting too hot, inflation starts bubbling up. And that's what happened after 2020. And we really started to see that inflationary number start to peak up above the trend line in April of 2021. I want you to keep that time frame in some sort of reference here, because again, when inflation happened in 2021, the Federal Reserve let it continue until March of 2022, when they first started to actually increase interest rates to try to cool off the growing inflation in the economy that we were in at that point. And right now, inflation has calmed down. That 4.1 number from May is actually closer to 3.1% in the June number, but it spiked back up a little bit in July to 3.2. There's a couple other things that the Federal Reserve looks at, obviously headline inflation. And we know that inflation as far as goods and services around food, especially energy and housing, has been the most stickiest inflationary numbers that we've had over this time frame. But there are certainly some indications that inflation is coming back down. So we want to assess where the government and the Federal Reserve have battled inflation and what that means for what's coming next. As we can see, the Fed's fight for inflation over the course of this past year, they took this opportunity in March of 2022 to increase interest rates from 0% at that point, and just recently in August raised them to where they are now at 5.5%. That's an 18-month time frame, and it's been the quickest increase in inflation in the last 40 years, or the quickest increase in interest rates in the last 40 years. Not since 1980, 1981 have we seen interest rates climb so high so quickly. But we want to give you a little bit of indication of what this chart is looking at. This chart obviously is looking at where the Federal Reserve has pegged inflation, right? And how that impacts all of our different savings accounts, investment accounts, and the like. But this chart is kind of showing you where the Federal Reserves, the FOMC is the Federal Open Market Committee. So there's 7 different board of governors, right? There's one in Chicago, Atlanta, New York, San Francisco, and places like that. You're going to see them all kind of chime in at different points during the month and kind of give their feedback for where inflation numbers are. But this is the collection of where those individuals feel like interest rates are going to head into the future. So as we see inflation cool off, that typically means that the interest rates are going to follow along lockstep. So what you're seeing here is the chart that very painful experience of increase in interest rates from 0 to 5.5% in 18 months. Well, that's good because most of the market and most of the Federal Reserve governors actually both agree that interest rates may be at their close to peak. Does that mean that they're done? Well, we'll get more indication over the course of the next week or two. So we actually have some headline inflation CPI numbers coming out tomorrow, and the Federal Reserve will meet next week on Tuesday and Wednesday to decide whether or not they increase interest rates any longer. Maybe they take a pause, and probably not very likely that they start lowering interest rates. But this chart gives us some indication of where interest rates may move in the future. So if we're at 5.5%, yeah, there's some indication that maybe another rate hike could be boiled into the numbers here. But I think if we look at where this blue trend line is, this is the Federal Reserve themselves saying that they would like to see the interest rate go down by 1% over the course of the next 12 months or so. They want to end up at the end of 2024 with a 4.6% interest rate. Beyond that, 2025, they want to get interest rates down to this 3.4% number. And the long-term number that they feel very comfortable with, that they hope to attain, is 2.5%. What I think is very interesting about this, as we look back over the 30 years or 25 years of this particular chart, is that we never see any kind of trend line lasting at 2.5% for very long at all, right? Why? Why might be the first question that comes to your mind. Well, overcorrection, right? I mentioned before that the inflation had started to peak above that trend line of 3.25 in April of 2021. By the time March of 22 came around, inflation numbers were spiking above 8%. So it tends to, as history has prevailed, tends to be the case that the Federal Reserve and our administration tend to be slow to react and typically overcorrect. So this is where we constantly talk about that pendulum shifting, right? Very common for the Federal Reserve to overshoot. They've been very cautious to not come in too hot, too heavy. But as inflation led to more sticky timeframes and wasn't fading away, it wasn't transitory like supply chain issues might have had us indicate. There was some ability for the inflation numbers to continue to be a little bit hotter. But that put the ball in the Federal Reserve's court to kind of battle it as aggressively as they possibly can. And that leads us to where we are today. So even though that they are trying very hard to avoid recession, they're trying very hard to not have disruptions because of interest rates, we know that a raise in interest rates does a couple things. It creates pain. It creates pain for the consumer. It creates pain for corporations out there. And so profits and ability for our assets to be spent or to use our assets starts to go the way of, going away for interest rate fees and things like that. So we want to take a little bit deeper dive into what happens when interest rates like this come about and how they usually dissipate and what opportunities that may lead to. On our next chart, we see that it's not just a United States issue. This has been a global theme, but it's not the only thing that Federal Reserve or European or international banks are doing differently. There's two ways that they can impact the rate of inflation. And there's two different ways that they can fight and stimulate the economy or try to cool down an overstimulated economy. And we can see both from the left and right-hand chart the two different ways that the Federal Reserve can do this here in the United States, but also what's done across the globe. The chart on the right is the easy one. The chart on the right is similar to the one we looked at in the last slide. It's a rise of interest rates, not only from the Federal Reserve, as we see that's the black line here, but it's also been the European Central Bank and the Bank of England. They have also kind of fallen in lockstep with what we're doing. Matter of fact, as you can see by the Bank of England, they were the first ones to start increasing interest rates. So the Federal Reserve was a little bit late to the game already by a global scale. And we see that the trend, at least the dotted lines that indicates the future progress of interest rates, have it definitely receding across the globe. But the shift of interest rates is just one fight that the Federal Reserve has. The Federal Open Market Committee and open market operations that they do not only can impact interest rates, as we see on the right, but they can also impact how much money is in the system, right? This isn't stimulus money. What this is looking at on the left-hand side is how much bond purchases or bond sales the Federal Reserve is doing. So are they indicating that they're taking money out of the system, or are they putting money into the system? And we can see that right now that forecast line, that trend line, is definitely a shift. We have the United States Federal Reserve, this black gray area here, is actually showing us that during the 2022 COVID pandemic and the time that followed, is they were actually infusing even more money into the open marketplace. Why? How did they do that? Because they were selling bonds, or I'm sorry, they were buying bonds here, but they were selling bonds on this side of it. When we sell something, what are we doing? We're giving somebody money. So the Federal Reserve was giving the United States consumer money in the tune of another almost $3 trillion during the after effects of the pandemic. And that, what you're seeing here is a major change and shift in their operations that are, again, trying to cool the inflationary bug that has this country by the throat. So the Federal Reserve has started actually doing the opposite. Instead of them selling money, they're buying bonds back. So they are buying bonds, or I'm sorry, they are selling bonds. And what that happens when I sell something to you, I'm taking your money. I'm taking the money from the street, or I'm taking it away from the ability for consumers to actually spend that. And we can see that that's already starting to approach $1 trillion. So a very big impact shift from how much money is in our system, from the interest rates that are making it hard for us to spend money. And it's also making banks and lenders have less money that they want to lend out right now, which is definitely an issue. So we see that happening and cooling. But when the Federal Reserve starts to take money off the table, that shift has shifted from almost $3 trillion in the system to now a difference and an effectual change of about $4 trillion no longer in the system as they start to shift from between buying and selling or selling to buying. That has led us, though, to very, very much a hot topic. That's called the inverted yield curve. So when we talk about yield curves, we should know what a normal versus an inverted yield curve is. And you're seeing both of them on this slide. A normal yield curve should mean the longer that I go out here on the bottom, the longer I go out, I should get rewarded for the risk that I take, because I know that it's not going to, my bond or my asset isn't going to come to maturity for 20 or 30 years. And it's very typically, if I'm going to do something short term, that I'm not going to get a great reward for that. But that's been the exact opposite effect of what has happened since interest rates started going up. Is that you can see here from December of 2022 when interest rates short term and now where they are at 5.5%, that's a completely different yield curve. This one is called an inverted yield curve versus this bottom one is the normal yield curve. So we as investors and individuals are actually getting rewarded for taking short-term bets on interest rate movements. Where do we see this? We see this in our bank accounts. We see this in CDs that are offered. We see this in government treasury bonds or I-bonds or anything that the government treasuries offer. Anything that's short term has got a really good interest rate tied to it today. And that may or may not be a problem, right? I think a lot of us that have been really good savers have seen our interest rates at our banks actually increase a little bit. Although I hope you do, and that's one different topic that we want to get into here over the next slide or two, is what should we be doing with our money at the bank? Should we be trying to get a higher interest rate? Is there interest rates available? And what about CDs, or what about investing in general? What should my investment account hold? Well, the hard part about looking at the yield curve is what's going to come next. And if we know that interest rates in the short term are up in this 5.5% range, what happens if what the Federal Reserve is mapping out actually takes root? What happens if they drop interest rates by 1% next year? What happens if they drop interest rates by another 1.5% the year after that? And the reality is, if we remember those slides a couple ago, is that the Federal Reserve rarely gets it right. So if too many things in our economy get broken, for instance, our labor market, our consumer spending, our corporate profit levels, that could certainly lead to a recession. And if it leads to a recession, that would give the ability for the Federal Reserve to actually drop interest rates again. As we can see, up and down and up, way down we go. And the interest rates have a very good chance of probably being overcorrected and maybe slammed back down to the floor to again re-stimulate the economy to get some money being spent. But in the short side, what we know for a fact is that if we're at the top of the interest rate hiking cycle that we're in right now, we're going to see this curve kind of flatten out or normalize a little bit. It will get back to a normal yield curve, but it may take us 2 to 3 years to actually get there. What they think the biggest thing that the talking heads on TV are talking about when they see an inverted yield curve like this is that almost every recession since World War II has been indicated previously or preceded by an inverted yield curve. So when we hear that dreaded R word on the TV or the radio, what we're actually hearing is statisticians come and say, hey, this typically happens 6 to 18 months before any recession. Well, when did the yield curve first start? It started back in March 2022 because the Federal Reserve didn't just start taking small steps towards increasing interest rates. They took some big leaps. So March of 2022 was just about 18 months ago. That led a lot of talk throughout the first and second quarters of this year, citing that we would likely go into a recession in 2023. We have not done that. Matter of fact, I think that the good old American consumer has stymied all the experts yet again, because instead of going into a recession, we keep on having some pretty good, solid returns. We see a corporate profit staying pretty high. We see that our balance sheets are still manageable. And I think from a personal level, we're still seeing consumers spend money. So at the end of the day, we are definitely at least kicking the can forward down the road when it comes to a recession. And now most economists and even the Federal Reserve has said that there is still a high probability of going into recession, but it's typically going to be a smaller recession or a short-lived recession, and it probably will come about in the first or second quarter of 2024. Well, obviously that still remains to be seen. So we will see what happens with regards to that, but I still think there's still a lot of opportunity if we're thinking about what should I do in case a recession is coming, or what should I do short term or long term. That's what we want to get into with today's discussion, to give you some actual advice that you can go out and make your money work harder for you. That is my ultimate objective when we work with our clients at Family Tree, is to try to have impact on all of their finances, not just the stuff that we manage for them. So let's take a look at some ideas as we look at how interest rates are affecting our portfolios. So interest rates are back, but you know what? Interest rates at our banks are fleeting. Most of our banks, if we go into a bank branch locally here in Idaho, what we're going to see if we ask a teller, I want your best savings account rate, typically that savings account rate is going to be 0.15%. Potentially lower. But what we should be getting out there on this side of the coin is that we should be doing our homework. We need to do a little bit of investigation as consumers, because a high yield online savings account right now is almost minimally getting us 4.25%. And I've seen some as high as 5.5%. These are FDIC insured accounts for up to $250,000 that can earn us rates of 4% plus right now. The average client that I talk to on a daily basis still has their money in just checking accounts or regular savings accounts, and they are getting robbed by their bank because they're not getting the interest rates that they deserve. So find a better bank. That's highlight number one. Find a better bank. But these are certainly do-it-yourself times. If I go into my bank branch and I say I want a high-yield savings account, they're going to tell me to go pound sand. They're going to tell me to go home and do it myself. And that's exactly okay with me because at least I know it's not very difficult to do. What does that typically mean to go and find a high-yield savings account? Well, there's companies like SoFi, Ally, Citibank, Discover Card, Marcus, they all offer these type of high yield savings accounts. They're not locked in or guaranteed for any amount of time, but they're just like the normal savings account of your bank. When interest rates start to fall, the interest rates in our savings accounts will fall lockstep with it. What you should know is that typically when I find people with assets at banks, they may or may not have a good interest rate. But what I typically find out is that they have way too much money in a savings account. How much money is right for a savings account then? Well, savings accounts are never going to keep up with inflation for the long term. That's why having too much money there is a detriment to your personal financial situation. When we're looking at what should be in a savings account, we should have 3 to 6 months of a savings for emergency purposes, right? So if I'm spending $3,000 a month, if I were to lose my job, get fired, or if I'm living in retirement, that's how many months worth of savings I should have in my bank. If my spending is $3,000 a month, I should have anywhere from $9,000 to $18,000 in an emergency fund. And my appeal to you would be to find a high yield online savings account for that. So your money can start earning a little bit more interest than it currently is at most banks. Here you see the national average just 0.5. So that means that we're certainly at an opportunity where we need to do a little bit of homework and comparison shop for ourselves. But beyond the emergency fund, the only thing else that should be a good fit for your bank is expenses, large expenses that you know you have within the next 1 to 3 years. So if I'm going to buy a car, if I'm going to replace an air conditioning unit for my house, or I'm saving up for a house or something like that in the next couple of years, again, a savings account is the best thing for you. But we shouldn't put too much in there, especially if it's something for long-term goals. One question a lot of our clients are asking themselves is, what can I do to make sure that not only am I getting the interest rates that the market's giving me right now, but how do I lock them in for longer term? And when we go down that path, usually what clients are looking at is a certificate of deposit at their bank. Again, utilizing our banks to try to get us some interest. And we know a certificate of deposit or a CD is something that's going to tie up my money for a little bit. I can go out there and I can get a 3-month or a 6-month CD, but I can also go out there and get an 18-month or a 3-year CD. Well, let's look at what the market is saying right now about CDs. Again, we have our national average CD right now at 1.68%. If I'm getting a savings rate above 1.68%, that's a no-brainer. Why would I move to a CD to lock in my money? The reality is, again, we have to comparison shop because we know that the competitive average out there in the marketplace for just a 12-month CD is over 5% interest per year. But it's not going to lock it in longer than usually that 12 to 18 months. And you can see here from just above that line that the national averages do go down as we look at longer term CDs. Well, why is that relevant? Why is that something that's actually happened? Our banks are not stupid. Our banks know that interest rates are getting ready to kind of turn the corner and they will come down. And so they're not willing to offer out any longevity towards interest rates. They will actually price a 3-year CD a little bit lower. So I can't really go out there and safely execute on locking in a good high interest rate in my bank today. And that leads us to a very interesting discussion about bonds. Bonds in general and specific bonds that would be a good idea for you to look at from an entry point standpoint. So if interest rates are back, is the risk of interest rates still going to affect my bond portfolio? Well, what happened in 2022? We know that interest rates impacted our stock portfolios, right? because we know that interest rates increasing is really bad for corporate profits. And so all the companies that need to borrow money to invest in themselves to build a bigger brand for themselves or to increase their sales and revenues and things of that nature, that those interest rates are prohibitive for them doing that. So that made the market really react in 2022 as the Federal Reserve started to line up their interest rate hiking cycle. We saw the S&P 500 as kind of the broad standard for the United States stock market went down 18% in 2022 year over year. So from January through December 31st, a negative 18% slide in 2022. We've been seeing that reverse course a little bit. And I'm hopeful that most of you on this call have looked at your statements since 2022, maybe pick your head up out of the painful sand that we had our heads in and see that our accounts are recovering a little bit. But it wasn't just the stock side of the equation that made our portfolios lose money in 2022. Interest rates spiking actually had the same effect. When interest rates go up, the prices of our bond portfolio go down. So we lose money on both sides. We lost money in the stock market because corporation profits were getting hurt. We lost money on our bond side, or our safe money, simply because interest rates were going so high that we couldn't keep away from the bond portfolio losing money. And the United States aggregate bond portfolio lost 12% in 2022. So if I had 100% of my money in stocks, I could have lost 18% or more. If I had all my money in bonds being safe, I still lost double digits. It was the first time that both halves, the stock and the bond market, went down that significantly, double-digit negative returns. That was the first time that happened in over 50 years. And it was one of the worst stock and bond market crashes since the era of the stock market, really, in 1926. So it was a tough year to go through. But where did that leave us as we look at 2023, right? We mentioned that the S&P and the stock market itself has rebounded a little bit. And it's simply because of the notion that, one, artificial intelligence is helping to kind of look at corporate profits and boost them. But two, the end is near on this interest rate hiking cycle. As we see inflation numbers come down, we see the ability for the Fed to start thinking about a pause. Well, it's important to note that after the last rate hike, typically on average, interest rates start falling down 9 months after the last hike. That's been the historical average of our nation over the last 50 years. That 9 months between the last rate hike and the first rate drop is very typical. So we saw our last rate hike in August. We may see one next week. But at the end of the day, we know that the writing is on the wall. And we know that we are going to see interest rates come back down a little bit. But for right now, we have good yields. We have yields in our bank accounts. We have yields or high interest in our savings accounts. We have them in our CD accounts, but we also have it in our bond portfolio. So I want to give you a little indication about what kind of bonds are out there and what kind of interest rates you can be getting for them, right? But I don't want to negate the fact that savings accounts and CDs still have a rightful place in our portfolios. Savings accounts are certainly for short-term money because we can go out there and get good interest rate now. I don't have to worry about interest rates taking away any of my money in a savings account. But if we look at how bonds are going to perform, or how they're performing at least right now, and we'll go into how bonds will perform in a raising rate cycle or a lowering rate cycle. But right now we can see that this access line has bonds that are on the left-hand side of this accent line are relatively safe bonds, right? These are U.S. Treasuries. These are municipal-backed bonds. These are corporate-backed or mortgage-backed securities. That means that they're relatively safe. There's not a whole lot of risk of default, but they still have some interest rate risk. But we can see on the safe side of the coin that we're getting interest rates in the mid-4 range, right? I can go out there and I can get a 4.25% savings rate or 5% CD. So why would I be interested in only earning 4.5% inside of a bond? Well, not all bonds are created equal. Matter of fact, the second column, as we see municipal bonds, right? Municipalities like the city of Boise, Ada County, the state of Idaho, and all of those type of municipalities across the United States, get created into these bond portfolios. The average bond portfolio for municipal is giving us an interest rate of 6.4% right now. Okay, that's pretty good. That means that I'm getting more interest out of municipal bond, but I am taking on some risk. But it's also helpful to know that a municipal bond portfolio does not pay taxes to the federal government. The interest that we make on a savings account, the interest we make on a CD is taxable, but the interest we make on a municipal bond is not taxable, at least on a federal level. It is on the state. But if our federal taxes are, let's call it 22% in the marginal tax bracket, and I'll let the professionals of Silverbridge help you with this equation. But I would say this, that if I'm looking at a 6.4% rate of return and I don't have to pay taxes on it, the equivalent rate of return that I'm getting on my municipal bond is actually closer to 8.2% when I compare it to a savings account or a CD, simply because that 6.4% interest is not getting taxed at the federal level. So that's one opportunity, is to look at all these different types of bonds, right? Having diversification in your portfolio is ultimately very important, but especially when it comes to having some money, or at least excess money in savings. A municipal bond or a portion of your assets that you have in liquid assets could certainly be looking at a municipal bond for a high interest rate of return and federal tax-free income. And we will see on the next slide exactly how that will get impacted if rates continue to rise or if rates start to fall. When we look at other bond portfolios out there, right, we have corporate bonds, we have mortgage-backed securities, asset-backed securities. We flip the script over to a little bit more risky side of the business when we look at bond portfolios. These EMD means emerging market debt. And we can see that the rates of return out there, or at least the interest yield that we get, is much higher if we go out a little bit further in risk. Is that right for you? Maybe, maybe not. But looking at a portfolio, they're probably going to combine a little aspect of each one of these inside of a bond portfolio for you. So if we're talking your investment portfolio, there's a lot of diversification to be had. If we're talking about savings, I would absolutely look at municipals as a way to save yourself a little bit of money in taxes going forward. But let's look at how interest rates going forward are going to impact our ability to save. So we may or may not understand the difference between, or how the two sides of the coin interact with one another. When interest rates go down, bond prices go up. When interest rates go up, bond prices go down. So there's that inverse relationship when it comes to bond performance. Here's what I'd say about this. It's almost like looking at today's environment, right? If I had a 4% CD or a 4% savings account and interest rates went up to 5%, what would I have to do in order to get out of my CD and go get a better interest rate? I'd have to sell it. But because interest rates are rising, now my bond or my yield on my CD is actually going to lower. I'm going to have to sell my CD or my investment at a discount. And so that's what happened in 2022, is everything got discounted because there were better rates coming. But as we turn the corner and that becomes the reverse of 2022, that's what we're looking at. Specifically, maybe it's a little bit harder to achieve in 2023 because we've had substantial rate cycles throughout the course of this year. But as we saw in the previous slide, we have an interest rate now that's helping us counter effect that growing or lowering bond price. But let's look at how interest rates might affect these various bonds in the future. So what you're seeing on the chart on the left, I know it can be a little bit busy, but we're seeing the blue line and the gray lines here. A gray line, as we can see at the bottom of this chart, indicates that interest rates, if they rise by 1%, what impact will that have on my bond return? If interest rates fall, that's the blue line that we usually are going to see on the right-hand side of this chart. But if interest rates fall, that's the return on my investment that I get for owning that bond. And we can see that there's not a whole lot of risk across the board. We're looking at the top of the chart as those United States Treasuries, anything from a 2-year out to a 30-year. Obviously, the longer I go out, yes, there's absolutely some risk inside that 30-year Treasury. But if we look at almost every other category here, The risk of owning bonds right now has dissipated so much because now bonds are earning interest. And two, that interest rates are set to start declining. So there's an immense opportunity for us to look at the excess money that we have in our portfolio, or going back to what a normal portfolio should be producing. Because as interest rates fall, for every 1% that they fall, let's look again at municipals. Municipal bonds right here towards the bottom half of the slide. If interest rates go up by 1%, we're going to lose 2.5% of our investment return, right? But what are we making? We're making that 6.5%. So even if I lost 2.5% because interest rates continue to climb, I'm still netting out a positive 4% interest rate, or a positive 4% return on my investment that year. I might have lost a little bit because interest rate fluctuation, but I'm still getting that natural interest rates that have been received in that portfolio that happen every 6 months, those coupons that we clip. But the reverse is true when we look at interest rates going down. A 1% fall in interest rates means that my municipal bond portfolio just experienced almost a double-digit return. Why? The same thing is true as this chart that we have on the right. If I'm getting 6% and my neighbor across the street can go out and get 5%, then they're willing to pay me a premium to sell them my coupon, to sell them my guaranteed 6% interest rate. And so they'll pay me money to acquire that. Well, that's a great situation to be in. That's the very normal allocation that we've experienced in our portfolios over the past 50 years in this country that we haven't had for the last 15 to 20 years. We've been in a very low interest rate environment. We've been wanting the United States Federal Reserve to get inflation to kind of moderate around 2.5%. It's been very difficult. It took COVID to actually get inflation to do what they wanted inflation to do, which is go above the 2% line. Now that it's there, they've got a fight on their hands, but they're hopeful to continue on a healthy inflationary level, and they're hopeful that they don't break a lot of eggs right now. But the truth of the matter is that interest rates are way higher than what they want long term. If we're at 5.5% and they want to bring interest rates down to 2.5%, that's a 3% difference. So multiply these returns that you see on these blue bars by 3, because that's the reality. If I have a portfolio that's going out there longer than the next 30 days, that if I have 10, 15, 20 years until I need my asset, then I can invest it on this yield curve and I can get some really, really good returns. Not only can I get good interest rates temporarily, but I can get a performance boost because interest rates go down in the future. So we got to look at this as a reality of what the writing on the wall is that a bond portfolio can actually produce a double-digit return potentially for the next several years. And that's a good place to be in. So I would just say my urge to you today is considering how much cash you're keeping on the sidelines, considering how much aggressiveness you're taking inside your portfolios. Because again, savings accounts are temporary. We know that they'll fall back underneath the thumb of inflation sooner or later, but enjoy it while you can. Try to find opportunities to lock in stuff with CDs if you have something that takes more than a year before you need it. But look at investing a little bit more. And how does this impact the way our portfolio construction has gone over the past year or two? Well, we've all heard probably in 2022 that a moderate portfolio, one that invests 60% in stocks and 40% in bonds, was one of the worst years to own a moderate portfolio. That is certainly not the case going forward, as now the normal ballast that we have between stocks and bonds is actually there. And for the first time in 20 years, we have that natural ballast once again. So take a look at your investment portfolio, take a look at your retirement portfolio, take a look at excess savings and determine if now's the right chance for you to follow where the ball is going and invest a little bit more in bonds to get a little bit more interest rates right now, hopefully some tax-free municipal bond savings, but also help your portfolio prepare for the worst. If recession is coming next year, we don't know how deep it's going to be. The crystal ball is cloudy and it gets cloudy every single day. But the reality is we know how bonds are probably going to react, and it's going to give us a great opportunity inside of our portfolios to have it positioned for excellence, to have it positioned as a great way to feel safe in the stock side of my portfolio by having my bonds protected so well. I will open it up for questions, but before I do, I just wanted to kind of talk a little bit about who Family Tree is. You have it in this slide here today. The Family Tree is just a small shop out of Eagle, Idaho. I'm the partner of Family Tree with my partner, Chris Eggleston, who's the founder of Family Tree Financial. There's 3 of us, 3 financial advisors with another one in training. And really where our mission statement is simply this. The reason we're called Family Tree is because we will never tell anybody anything that we wouldn't tell our own family members. And so that's led to us to have some long-term experience and long-term success helping families, individuals, and business owners in the Treasure Valley and surrounding areas. And I'll put our contact information on the board here for you as well, in case you want to reach out to us in the future. I'll open it up to questions, and I'll kick it back over to you, Brittany.
Thank you, Stephen. That was so informative. And as you said, the numbers are like ever changing. So what a challenging presentation to prepare for the last few weeks, but that was
It stood the test of time. Thank you.
Yeah, exactly. And I love your mission statement. Just makes you feel like you can trust the person you're investing your money with and having them help you figure that all out. So
let's be honest, it sounds hokey, but it's the truth.
No, I love it. Okay, so we have a couple of questions that have been typed in, and if you have them, everyone, please continue to type them in. We can also just unmute yourself. I will start it off here. What are the requirements for opening a high yield savings account? I've heard you have to have a pretty high amount to keep in it, but then you seem to answer it, and it's really like another savings account where you just have to have 3 to 6 months of that's about the right amount. There's not like a necessary requirement of a higher amount to have in it.
Yeah, so all banks are not equal, right? So I bank personally, I have my checking account set up at Wells Fargo. If I had a savings account there, they'd give me 0.15% interest. US Bank, Chase, very similar, probably even lower interest than that. That's still highway robbery, in my opinion. What do I need in order to open a high yield savings account? I probably need at least $1,000, but maybe not even that. But again, check the fine print. When we guide people to look at high yield savings, we like a few, right? Who do I use for a high yield savings? I use Ally Bank, ALLY. They're not the only game in town. But again, what I would say is comparison shop. There's a couple different websites to look at all the nuances, all the gotchas. And I think that's where we want our clients to look today, is find out those gotchas, but do some comparison shopping. Where? 2 websites that I'll give you, nerdwallet.com. And it's a funny one, but it's one I use. It helps you compare savings account, investments accounts, mortgages, you name it, and there's a good comparison. Also look at bankrate.com. Bankrate.com will do the same thing as NerdWallet, help you compare a bunch of different banks and institutions out there and show you which ones are the highest rated. So independent rating systems are good. But what I need for a high yield savings, I don't want to put anything in there that I'll need for tomorrow. So all my normal fluctuations, all my bill pay, all my ins and outs of my salary or my wages, those go into my checking account. Mm-hmm. My emergency fund is something that I should safeguard from actually using it unless I have an emergency. That's where your high yield savings are. If it's $25, I'm sure it meets some companies' minimums. And that's the thing, that you do not have to play these games that our local banks are doing, where you have to put $10,000 in before you start earning. You can find one of these online high yield institutions. They're reputable companies. They simply just don't have the same overhead as a brick and mortar bank that's on every street corner. So look online, because they are do-it-yourself. Even ICCU has a high yield online savings account, but it is an online savings account, one that you have to open for yourself. So you have to do it through your computer. You want to make sure all the gotchas are listed, but most of these high yield online savings accounts do not have any gotchas. There's no minimums. There's no account maintenance fees. There's no link to do automatic direct deposits and all the weird stuff that our local banks have been forcing us to do for the last couple of decades. So comparison shop, use bankrate.com, use nerdwallet.com, and by all means, my number's on the screen. Give us a call if we can help.
Okay, awesome. Thank you. Another question, if you don't have a financial advisor helping you look at where to have your money, do you have a suggestion for how often you should do bank shopping comparison for better interest rates? I mean, that almost feels like it could be like a full-time job where you're like going to, constantly look around. Is there like a good suggestion for a timeline on that?
No, I mean, as far as, how often should I check? The reality is we haven't had this opportunity to check for about 15 or 16 years. Interest rates have been this low since the market crash of 2007, 2008. So since then, we have 16 years where it wouldn't have made a difference if you checked every week or once a year. We were getting practically zero. But now, since the first time and since 2007, it's just worth a look right now.
Got it.
If you find a company that has a good interest rate, ride the wave down. We know interest rates won't stay around forever, but it's always a good idea to kind of comparison shop if you're having a large balance in your savings accounts.
Okay, thank you. Another question, should I pull the trigger now on buying bonds or wait 6 months to a year?
We've all been talking about this all year. When is the opportunity going to present? And the reality is we don't know. The crystal ball, like I said before, is very cloudy. It changes every day. But now is a good point from that last slide, and I'll bring it up here, hopefully on the screen again. See if I can. Right? Here's the reality is that there's really not a whole lot of risk. And I don't want to give blanket advice here, but if we have assets that are not needed for anything in the short term, and by short term, I mean within 3 years, then it's worth going out there and acquiring some risk so you get better returns. How much risk are we taking? Not very much. We're taking low single-digit risk to hopefully have some high double-digit returns. And even if we can't achieve this, if rates hold steady for a prolonged period of time, we have good interest rates. So it's all a matter of just making sure you get yourself positioned. Are you missing the boat if you wait 6 months? Probably not. But like I said before, from that last rate hike to the first rate drop is typically a 9-month window. So did that clock start ticking a month ago when they raised rates in August, or will it start in September if they raise rates next week? We don't know. But I don't think it's worth the hesitation if your allocation towards savings is appropriate and you have a proper emergency fund to go out there and look for some longer term investing options inside the bond portfolio. Again, to each their own. Risk levels matter, but we could be looking at portfolios that both incorporate stocks and bonds. There's no such thing as all or nothing. It's finding the right proportion for yourself.
Okay. Anybody have any other questions? There's nothing else in the chat, but if you do, you're more than welcome to just unmute yourself. And if not, Stephen, I will, when I edit this video, I'll send it out to everybody, to a lot of the people who weren't able to join us. And are you okay with everybody emailing you if they come up with any other questions?
Absolutely.
Okay. Awesome. Well, thank you, Stephen, very much. Again, that was such a wealth of knowledge. So thank you for sharing that with us. And to those who were able to hop on, we appreciate you joining us.
Thanks so much, Brittany.
All right.
Appreciate the opportunity.
Okay. Of course. Thank you. Bye.
Thank you for watching this summer speaker series. If you would like to tune in to future presentations or connect with this speaker or Silverbridge CPAs, please visit us online at silverbridgecpas.com.